Hello everyone, this is Sebastian McMahon from IA Financial Group and I'm back with the weekly economic review for the week ending September 27, 2024. So we'll be talking about China a lot this week. There was a new stimulus package that came out. Of course, we've been discussing over the last few months how China's economy has been lagging since the reopening post-COVID. It's a balance sheet recession that's underway. It looks a lot like what Japan went through in the 1990s when there was excess leverage in the economy and they decided, well, they were forced at some point to deliver the economy, which means that monetary policy becomes inefficient because no one is looking to borrow. When you have excess income, you tend to use that to pay your debt. As businesses and households also selling off assets to pay off the debt, so it's hard to stimulate the economy with monetary policy because the credit cycle kind of gets stuck in this moment. So there are other ways to intervene there. We'll discuss that in a few minutes, but China is moving. So far, is it enough to say that they're going to save the economy? Probably not, but they're very serious about propping up the stock market, and so far so good this week. So we'll discuss that, but before we get there, look at this week's markets at the close on Thursday. Negative for fixed income since we had the 50 basis points cut from the Fed. It seems that the market is believing now that rates will come down quickly enough to save the economy, to keep the economy afloat. So growth expectations are revised higher. Inflation expectations seem to be revised higher also because rates have been moving higher, so it means negative returns for the week and also last week on Canadian bonds, but still positive returns on the year. For the stock market, this is an absolutely stellar year that we're seeing, about 23% in the US. We're up now 18% for emerging markets with this week's moves. Stock market in Canada 17.25%. Europe is lagging behind, but lagging at 15% in Canadian dollars, so that's still pretty good, pretty solid year. Price of gold up another 2% this week. When there's anything that can be seen as inflationary announced, gold does well. Then when there's uncertainty, gold does well. When rates are falling, gold does well. So very good setup here for the price of gold, which is now reaching 30% year to date. So China now. So here I have two things from Reuters on the left, from Financial Times on the right. Just taking the time here to explain what's going on. So China is taking baby steps, but still very important steps to bolster the economy. On the left, you have what's more fiscal. I would say China is to issue $284 billion of sovereign debt to help revive the economy. And as I mentioned earlier, when you have a balance sheet recession, the credit cycle is stuck. One thing that has been shown to work in history is what we call helicopter money, just sending money to households to prop up consumption and to prop up also investing in the stock market. So this is what they're doing, about $114 US dollars a month per child to all households with two or more children. So excluding the first child. So anyways, just putting money in people's pockets to get them to consume, and that's a good way to usually kickstart things when the credit cycle is not working. So there's those measures here. On the right, those that might be more useful here for global investors. The People's Bank of China, they unveiled a war chest to boost the stock market by lending to asset managers, insurers, and brokers to buy equities, and also to listed companies to buy back their own stock. So they really want to prop up the stock market because in China, consumer confidence tends to be more tightly linked to what goes on in the stock market than in other places around the world. And what's interesting is the third paragraph here. The funds allocated could be doubled or tripled if the schemes work. So this kind of has a whatever it takes kind of feel here, which is putting investors in confidence here. So we've had a good response from local investors, and also foreign investors are starting to prop up and say maybe it's time to dip our toes into Chinese equities. And it's starting to move already pretty quickly. So if we look at the performance of the stock market in China, on the left you have MSCI China. That's 5 years of data. I wanted to show how much of a slide we've seen since the last peak in late 2020, early 2021. We lost about 50+% in China over that span. Now we've had a very good week. If you look on the right, it's 13.6% over the last 5 days, all the way to the close of yesterday. But on the chart on the left, doesn't look like much yet. So there's lots of upside here if it works, the big if, but if it works, there's a lot of upside. If they are as determined as they say to prop up the stock market, and they're very serious and they keep pumping that liquidity, likely they will achieve some results. If the economy starts turning in the right direction, because the housing market over there is at the center of all of this, it might take more than what they've announced to save it. But if we start to see a bottoming at some point and confidence returns, there's a lot of upside here for the Chinese stock market. So this is what we wanted to show. So this is holding risk appetite around the world higher this week, and if it works, could give some legs to the market here. So in the US, maybe very quickly, the road to the presidential election. On the left, you have the polls. Miss Harris continues with to hold the lead, a bit. Pulled back a little bit on the week, but still in the lead. Battleground states are where it's at, and Miss Harris, if she wants to secure a win, she would need to win all of the swing states. As you can see here, she's behind in Georgia and Arizona by a fair margin, so those are not given for sure. Again, it's an electoral college in the US. You need to look at every state, and here on this chart you can see that the electoral college remains too close to call. Last week we had a slight advantage to Harris and Walz. This week it disappeared. Now it returns to an advantage for Trump and Vance, but the toss-ups in the middle, 104, means that it's too close to call. We cannot, there's no way that we can predict who is going to win this election yet. There's good momentum for Miss Harris, but it will come down to likely a few dozens of thousands of votes, likely in some states. So nothing new here, still very tight. And we'll keep you posted when anything changes here as we approach the early November election. So what we'll be watching next week in Canada, S&P Global PMI and S&P of manufacturing PMI and services PMI. In the US, the ISM manufacturing and services indices will be out. Still a bit below 50, so still in contraction for manufacturing, still positive, above 50, so still in slight growth for the services index. And we'll have the jobs report in the US, very important report. Continuation of last month, about 140,000 jobs added, so pretty much the same number as last month. Unemployment rate still at 4.2%, so the normalization of the labor market continues in the US, at least is expected to continue, so we'll be watching that next week. So that wraps it up for the week. Always a pleasure to serve you. If you appreciate the content here, please share, and of course come back again next week.